What's up guys, E-Man here, and in today's video lesson we're going to be talking about money management and why it is king in trading. Now, money management is arguably one of the most important factors in trading, and I'm going to be talking a little bit about what money management is, and then we're going to be talking a little bit about what you can do in your trading to improve your money management so that you can become a more profitable and consistent trader. So let's dive right into it. So what is money management and why is it so important in trading? Well, basically, money management is the core foundation of any successful business, and it's exactly what you think it means. It's basically the management of money. And as traders, our main job is to manage our own money in a way that allows us to maximize our profits and minimize our losses. Now, there are two main components of money management in trading. One being trade sizing, so how much you're risking per trade, how much share size you're using, and the other being your risk-reward management. So how much you're risking and winning per trade on a trade-by-trade basis. Now, many people come into trading with poor money management skills to begin with. If you think about it, the average American spends about 4% more than they earn per year. So it's really no surprise most people lose money in the market when they can't even manage their finances properly at home. Now, if you're someone who has poor finances at home, maybe you're in debt, maybe you spend way too much than you earn, then trading's probably not the right job for you, and you might want to consider, thinking about it before you jump into the market. So let's move on to the next slide and we'll talk about trade sizing and risk. So how much should you be risking per trade? Well, as a general rule of thumb, you should be risking no more than 1 to 2% of your total equity balance per trade. Some experienced traders who are more aggressive, they may choose to risk maybe more than 5% of their account, but that's totally up to them and they have the experience to do it. But I recommend no more than 1 to 2% for most traders. Now, for new traders, you should be risking no more than 10 to 20 bucks per trade max until you develop the proper skills to consistently extract money from the market. You really have no business risking any real money until you finally develop those skills. Now, I wish I knew this as a new trader, and I wish someone told me this, because I could have saved myself a ton of money by not risking so much so quickly. And I know a lot of traders jump into the market and they want to make money fast. Trust me, I've been there. I know what it feels like. And, that's just not the right mindset, guys. You really got to take it slow. This is just like any other job. You don't go from 0 to 100 just like that. You got to do it gradually and slowly build up. Slowly learn and slowly build up those skills to, really become consistent and start making some real money. So stick with that small risk, 10 to 20 bucks a trade until you can see some consistency in your trading. Then you can start to consider adding more risk. Now, don't fall for all the BS marketing. You see these ads, these gurus saying, I turned 500 into $1 million. That's great. That's great for them, but they're selling a pipe dream, guys. To grow a small account that exponentially, you would need to take on extreme risk and you would likely lose all your money trying. So, is it possible to grow an account to that size? Sure, it's possible, but it's not really realistic. The smaller your account, the longer it will take to grow. Don't expect to turn 1K into 100K in a month. That's just not realistic at all. And even if that is possible, you'd have to take on extreme amounts of risk and unnecessary amounts of risk just to accomplish it. Just like with any other business, the more money you have in trading, the easier it is to grow. So for those of you with small accounts, don't rush it. It's a slow process. If you try to rush it, you're probably going to fail. So, take it nice and slow and stick to that 1 to 2% per trade risk. So let's talk about smart risk management versus dumb risk management. So smart risk management, we have trader X who has a $30,000 account and he's risking 1% of his account per trade. So let's say he buys 3,000 shares of stock XYZ at $2 a share and his stop loss is at $1.90. So he's risking 10 cents a share, that's 300 bucks. Now, if you think about it, it would take him 100 consecutive losses in order to blow his account. So this trader is giving himself such a big cushion And it's very unlikely he's going to blow his account, you know, anytime soon, or if at all, you know, with that kind of risk management. Now let's look at dumb risk management. We've got Trader Z, who has a 5K account, and he's risking 8% of his account per trade. You know, maybe he signed up to some guru who promised him he can turn 5K into $1 million, who knows, and he's learned some really bad habits along the way. So he decides to buy 2,000 shares of stock XYZ at $2.25, and his stop loss is at $2.05. So he's risking 20 cents a share with 2,000 shares. That's $400. So that's 8% of his account right there, right? Now, if we look at this, it would only take him 13 losses in a row to blow his account. So which one of these traders do you think has better odds of succeeding in the long run? It's pretty obvious, right? Trader X. So Trader X not only has a bigger account, but he's also much smarter with his risk. And maybe Trader Z is trying to grow his account too quickly. You know, he sees other traders making maybe a lot of money and he's trying to compare himself to them. And that's really not the right habit, guys. You really can't compare yourself to others because trading really is a personal journey. You know, and someone with a 5K account, you can never compare yourself to someone trading a $500,000 account. That's just not realistic. And you never know how big someone else's account is. You know, they might be showing you their P&L. It might look great, but you have no clue how much they're risking per trade. So don't try to mimic them. You know, stick on your own journey and, you know, use smart risk management. All right, now let's talk about risk reward versus win rate. Now, the thing you need to know about trading is it's not about being right. It's about making money. And you can have a really high win rate and still lose money in trading. However, it's very difficult to lose money when you have great money management. The bigger your risk reward ratio, the lower your win rate will be. So try to aim for at least a 2-to-1 risk reward ratio, meaning your reward is at least double your risk. So ideally you want to aim for at least 3 times your risk or more. That would be best, and the higher the better. Now, it's okay to stop out of trades. This is something you really need to understand. You know, you can always make back a small loss, but ignoring a stop even just once can really set you back financially and mentally. So, you know, don't let stops upset you. You know, they're part of the game. Just take them and move forward. Now, here's an example of 2 traders with different risk reward and win rate statistics. Let's say Trader X has a 75% win rate and he averages about 1.25 R per trade. Now Trader Z has a 50% win rate and averages 2.5 R per trade. Which trader do you think is making more money? Do you think it's Trader X or Trader Z? Well, believe it or not, the guy with the lower win rate is making more money. Why? Because he's letting his winners run and minimizing his losses better. You know, this job is all about risk reward. You know, you can have a very low win rate and still be very profitable in trading. So it's wise to focus more on risk reward as opposed to your win rate. And that brings us to cut losses quickly and let winners run. We've heard it all before, right? It sounds so cliche, but it really is the key to consistently pulling money from the market. The question is, how do we do it, right? Try to think of it like this each time you enter a trade. When you're in the trade, say to yourself, okay, I'm fully prepared to lose money on this trade. However, if it happens to work for me, I will be patient and I will let it reach my target price before closing it out. So going into a trade with this kind of mentality, you're basically prepared to lose already. So taking a loss is not really going to impact you mentally. And when your winner is working for you, you're going to be more patient with it because you're really not scared to stop out of the trade. Now, most traders are terrible at this because they're so scared of letting winners turn into losers and they hate losing money. And, you know, I don't blame them. You know, we're only human. Nobody likes to lose money, right? But if this is a problem for you, then you simply must reduce your risk to a point where you are in a carefree state. So only then will you be able to cut your losses without hesitation and then allow your winners to really work for you. Being in that carefree state means you're really not worried about the money you might lose. So you're trading with a risk that is comfortable with you, and you're allowing your winners to run because you're not obsessing over, oh no, what if this trade stops me out, or what if it doesn't work? It really doesn't matter at the end of the day. You know that this is a game of statistics and probabilities, and you're just letting the trade play out as it should. And this job is a lot like football. You can't expect to play in the NFL without taking a few hits. And a lot of traders don't seem to understand this. A lot of traders try to avoid taking losses, but just like football, you're going to take hits in trading. You're going to take losses, and there's no avoiding it. And the great traders embrace this and fully accept it as part of the job. So now let's briefly review what we just talked about. So you want to be risking about 1 to 2% of your account per trade at most. As your account slowly grows, so will your risk naturally. Don't be comparing yourself to these gunslingers. For all you know, they could be risking 20 or 30% of their accounts per trade. And that's really just a recipe for disaster. If you want longevity in trading, be smart with your risk management. Keep your risk small, keep your risk tight, take it slow and steady. Don't try to be a gunslinger. And learn to embrace losses. Your job is not to avoid losses, it is to manage them. And as a trader, you're going to be taking loss after loss, and that's just part of the job. Just like a football player gets hit on the field, you're going to get hit in trading, and you better be able to get back up. Otherwise, this job's probably not for you. And don't get too caught up with your win rate. No strategy works 100% of the time. Even if there's some gurus selling you a perfect strategy, it's BS. Nobody has a great, perfect strategy. The best traders have maybe a 70-75% win rate, so they still lose about 1/4 of the time. And money management should be your #1 focus. So keeping those losses tight and really maximizing those winners, that should be your #1 primary focus. And lastly, stop falling for the BS guru marketing hype. Trading is not a get-rich-quick scheme, guys. It's arguably one of the most difficult jobs, and it takes a lot of time and hard work to master. So don't think just because a guru shows you he turned $500 into $1 million that you can do it as well. Sure, it may be possible, but it's a very reckless and stupid way of trading, and you're really better off just trading smart, taking it slow and steady, and gradually growing your account the smart and effective way. So that's it for this video, guys. Really hope you enjoyed it and found it helpful. If you found it helpful, I'd really appreciate it if you shared this video. Maybe it can help out some other traders. And if you have any questions or comments, please feel free to leave them down below and I'll be happy to answer them. All right, guys, cheers.